Imagine spending 40 years working. 40 years of paying into a system that promised to take care of you. And then the day finally comes, you claim Social Security, and within 12 months, you discover that the government is quietly taxing up to 85% of that check you worked your entire life to earn. Not because you did anything wrong. Not because you made a mistake. But because of a rule buried so deep in the tax code that most financial advisors won't even bring it up until it's already too late. This is happening to millions of Americans right now. In 2026. And if you're planning to claim Social Security, or you already have, what you're about to hear could change everything. Stay with me. Because this gets darker before it gets clearer. If this kind of hidden financial truth is something you need in your life, hit subscribe right now. The people watching this channel are the ones who don't get blindsided in retirement. Let's make sure you're one of them. Here's what nobody tells you when you walk into the Social Security office and start that claim. The check you receive every month? The government doesn't actually see it as a tax-free benefit. They see it as income. And depending on how much other money you're pulling in, from a pension, from investments, from a part-time job, from retirement account withdrawals, they can tax up to 85 cents of every single dollar you receive. Think about that. You paid into Social Security your entire working life. That money was already taxed once when it left your paycheck. And now, in retirement, they can come back and tax it again. It's one of the most quietly devastating financial traps in the entire American tax system. And almost nobody sees it coming. Let's walk through exactly how it works, because the mechanics of this rule are where the real danger lives. The IRS uses something called your combined income to determine how much of your Social Security benefit gets taxed. Combined income sounds complicated, but here's what it actually means. They take your adjusted gross income, add in any non-taxable interest you earned, and then add in half of your Social Security benefit. That total number is what they use to decide your fate. And here's where it gets terrifying. If you're a single filer and your combined income lands between $25,000 and $34,000, up to 50% of your Social Security benefit becomes taxable. But if your combined income crosses $34,000? Now up to 85% of your benefit is on the table for taxation. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Now here's the part that should make your blood pressure spike. Those income thresholds? They were set back in 1983. Over 40 years ago. And they have never, not once, been adjusted for inflation. Which means every single year, as Social Security benefits rise with cost of living adjustments, more and more retirees get quietly pushed above those thresholds without ever earning a single extra dollar in real terms. The government designed a trap and then left it sitting right in the middle of the road. And millions of retirees walk straight into it every year. But wait. Because here's the part that nobody sees coming. Let's talk about what this actually looks like in real life. Picture a retired teacher named Margaret. She's 68 years old, lives in Ohio, worked 32 years in the classroom. She claims Social Security and starts receiving about $22,000 a year in benefits. She also pulls about $20,000 a year from her IRA to cover living expenses. And she has a small pension of $8,000 annually from her years of service. In Margaret's mind, she's doing everything right. She budgeted carefully. She planned. She saved. But here's what her tax preparer discovers in April. Margaret's combined income, her IRA withdrawals plus her pension plus half her Social Security, comes out to just over $41,000. She's a single filer. That means up to 85% of her Social Security benefit is now taxable income. On a $22,000 benefit, that's nearly $18,700 suddenly subject to federal income tax. Margaret never planned for that. Her budget didn't account for it. And now she's scrambling. This isn't an edge case. This is the story of millions of American retirees in 2026. And the cruelest part? Most of them are still discovering it for the first time when they open their tax bill. Drop a comment below if this scenario sounds familiar to you or someone you know. Because you are not alone in this, and the fact that you're watching this video right now means you still have time to do something about it. Now let's talk about June specifically, because the timing of when you claim Social Security and how you manage your income in the months leading up to and following your claim can make an enormous difference in how much of your benefit ends up taxable. Here's the thing most people don't understand. Social Security benefits are not taxed in isolation. They're taxed in the context of your entire financial picture for that tax year. So if you claim Social Security in June of 2026 and you've already spent the first 6 months of the year pulling heavily from your IRA or collecting pension income, you may have already set yourself up to breach those combined income thresholds before your first Social Security check even hits your bank account. That's the trap within the trap. And it gets even more layered. Because the Social Security Administration pays benefits in arrears, meaning the check you receive in June is actually for the month of May. So the income timing isn't always what it seems on the surface. If you're trying to manage your taxable income strategically, you need to understand exactly what's hitting your tax return and when. Most people walk into this completely blind. And their financial advisors, the ones who should be helping them navigate this, often fail to run the full tax projection before the claim is filed. By the time the mistake surfaces, it's already locked in for that tax year. But here's the good news. And yes, there is good news. Because this is not a rule that can't be worked around with the right planning. The single most powerful tool available to retirees facing this problem is called a Roth conversion strategy. And if you've never heard of it in this context, listen closely, because this could be the most valuable 2 minutes of financial information you encounter this year. Here's the core idea. Your IRA withdrawals count toward your combined income. Every dollar you pull from a traditional IRA pushes you closer to, or further above, those Social Security taxation thresholds. But Roth IRA withdrawals? They are not counted in your combined income calculation. 0. They are completely invisible to the IRS when they're calculating how much of your Social Security gets taxed. So if you can strategically convert portions of your traditional IRA into a Roth IRA in the years before you claim Social Security, or even in the early years of retirement before your benefit grows larger, you can dramatically reduce the amount of taxable income that shows up alongside your Social Security check. You pay the tax on the conversion now, at potentially lower rates, and you protect your future benefits from being taxed at the worst possible time. This is not a loophole. This is not a trick. This is legal tax planning that the wealthiest retirees in America have been using for decades. The difference is that nobody told you about it. But there are other levers too. Harvesting investment losses to offset gains. Timing large IRA withdrawals in years when Social Security income is lower. Choosing between standard deductions and itemized deductions strategically. Delaying Social Security to increase your benefit while doing Roth conversions in the gap years. Managing pension income timing. Every one of these decisions interacts with the Social Security tax calculation in ways that most retirees never realize until the damage is done. And here's where the emotional weight of this story really lands. The people most hurt by this rule are not the wealthy. The wealthy have accountants and financial planners who map this out years in advance. The people most hurt are the middle-class retirees who did everything they were told to do. They saved in their 401k. They built a pension. They waited until full retirement age to claim their benefits. They played by every rule. And then they got hit with a tax bill they never saw coming, not because they were irresponsible, but because the system was never designed to protect them from this. There is something deeply unjust about that. And it's worth saying out loud. If this video is making you feel something right now, share it. Put it in front of the people in your life who are approaching retirement or already in it. Because mainstream financial media doesn't talk about this the way it deserves to be talked about. The people in this comment section, the people watching this channel, they are the ones who take this information and actually do something with it. And sometimes sharing a video like this with the right person at the right time changes the entire trajectory of their retirement. Now let's bring this home with something practical you can do right now. First, run your combined income number today. Take your expected adjusted gross income for this year, all sources, add your non-taxable interest, and add half of your annual Social Security benefit. If that number is approaching $34,000 as a single filer or $44,000 as a married couple, you are inside the danger zone. You need to have a conversation with a tax-aware financial planner before this year's return is filed. Second, if you are between 60 and 70 years old and haven't claimed Social Security yet, consider this your wake-up call to look at the gap years between now and your claim date as a Roth conversion window. These are often the lowest income years of your retirement, which makes them the most tax-efficient time to convert. Use that window before it closes. Third, if you are already claiming and you've been hit with unexpected taxes on your benefits, know that there are still moves available. Strategic charitable contributions, qualified charitable distributions from your IRA, adjusting your withholding directly from your Social Security check. These are all real tools that can reduce your tax exposure going forward. The game is not over just because the mistake has already been made. But you have to know what moves are available to you. And you have to be willing to play active defense. Here's what I want you to hold on to as this video ends. The retirement system in America was not built to be simple. It was not built to be fair. And it was absolutely not built to announce its hidden rules to the people most vulnerable to them. The 85% taxation threshold has been sitting in the tax code since 1983 like a silent landmine, and every year the inflation that erodes the purchasing power of your benefits also pushes more of those benefits into taxable territory. That is not an accident. That is the architecture of a system that has never been updated to reflect the economic reality of the 21st century retiree. But here's the thing about landmines. Once you know where they are, you don't have to step on them. The knowledge you carry out of this video is worth real money. Real, measurable, retirement-protecting money. And the people who act on it, who run those numbers, who have those conversations, who make those adjustments, are the ones who get to keep more of what they earned. You spent a lifetime building this. Don't let a 40-year-old tax rule take it from you quietly. If this video helped you see something you didn't see before, leave a comment. Tell me where you are in this journey, still planning, recently claimed, already hit with the tax surprise, because every story in that comment section helps someone else feel less alone in this. And if you know someone headed into retirement in 2026, share this with them today. Not tomorrow. Today. The Retire Shield channel exists for one reason, to make sure you see what's coming before it arrives. Subscribe if that's the kind of intelligence you need in your corner. Because retirement isn't the finish line. It's the beginning of the most important financial chapter of your life. And you deserve to walk into it with your eyes wide open.